Up here today, we have really an all-star cast, and you guys are really lucky that we have them all in one place. Over the last 2 weeks of August, things are really quiet, right? I mean, people are on vacation, out of office replies, but here we are, post Labor Day, and we're excited. Let's get some deals done. So I think the best place to get started is everybody up here is intimately involved in the success of the IPO journey. So let's just kick it off by everybody introducing themselves and their role. So,
Sure.
Jay, you want to get started?
I will. Pleasure to be here, everybody. My name's Jay Heller. I head capital markets at Nasdaq. I also live on a corner house, Seth, just so you know.
Thank you. It still hurts.
It's okay. I've been very fortunate and I've been very privileged over my 16-year tenure at the exchange to have welcomed over 3,000 IPOs. And they're not all big and they're not all small, but sure enough, they sure do matter. And so I'm a very firm believer in capital formation at any size, at any place, at any point in time. So really looking forward to the conversation today. We've got a stellar panel, and I thank you for being here.
All right, thank you, Jay. John Heidenreich, head of capital markets at RF Lafferty & Co. We're at 40 Wall Street. I've been in the business a long time, and I'm pleased that Jay is here. So I work to put together the books when we get a IPO assignment, and we may talk a little more about that. But many of you know me because I'm out talking to you about helping us get the money down for the deal. And one of the last things we do to get public is we call Jay Heller and say, Jay, we're ready. Can I have the 10:35 slot tomorrow morning? And Jay says, John, for you? Always. Always, exactly. So, I'll pass on to Ross.
Good to see everybody. Ross Carmel, the founding partner of Carmel, Malazzo & File. We are a law firm with our main office in Midtown Manhattan. I love my job. I consider myself an entrepreneur just like everybody in this room. I love seeing entrepreneurs like you take an idea and then bring it to the IPO, right? It's the ultimate next step for you to grow your business and continue that successful journey to the next stage and hitting those milestones. Just a little background, I am an entrepreneur. I started my own law firm, 2 guys working out of a WeWork. 7 years later, we're 30 lawyers, 4 offices, and we're one of the most active securities law firms in the United States today. Woo! Thanks, Lisa. So, obviously, as the lawyer, we're here to help you guys not only with, getting you prepared for your IPO from a legal perspective, due diligence perspective, and then ultimately getting that registration statement effective with the SEC and approved by the exchange, whether it's the CBOE or Jay over at the Nasdaq.
Bill? Thanks for the plug, Ross. And I need that 10:30 spot, so that's what I'm here to do. My name's Bill Collins, everybody. I'm with CBOE Global Markets. I'm a director of U.S. listings. My background is all capital markets all the time. Jay and I worked together at Nasdaq for several years. I ran business development for 3M Law 100 firms, and I was the head of West Coast sales for Topan Merrill prior to that, Vintage Filings, where Seth and I got to know each other just about 15, 18 years ago. So very happy to be here. This is CBOE's first time at NEBA, but you will see us, and you will see us a lot going forward. Thank you.
So, thank you, everybody. So you've got a sprinkling of just about every part of the journey up in front of you today, and I've got a bunch of questions, to be pointed, at some of you. But let's just go around one more time in terms of what is your definition of a micro cap IPO, which is sort of honing in on the focus today, and what do you see as the state of the union of that category?
Yeah, so I think, a microcap IPO is kind of a term of art in our space. There's no, defined definition that you can find on Investopedia. But what I can tell you is how I define it is, an IPO between $5 and $15 million, just about. And in the current market climate, we're seeing smaller and smaller IPOs. So what I can tell you is we did, as a law firm, we did 20 public offerings this summer. And I think the largest deal size was $7.5 million. So the good part is deals are getting done. We're just getting creative in how we're getting them done through structuring your IPO appropriately in order to reduce the offering size needed to qualify for the CBOE or for Nasdaq.
Yeah, I would echo some of what Ross said, that the definition of a micro is doing just what you need to meet the minimum requirements. And many of these companies are young, they're early, they may or may not have revenue, they've probably had a string of losses. You're looking to be able to get the minimum shareholder equity, you're looking to get the minimum publicly traded, unaffiliated, unrestricted float, which is 15 million, whether it's Nasdaq or the ASE or CBOE. And you're typically looking so it's not so big a lift because you want to get it done. Everybody wants to get the deal done. Nobody who's a service provider, be a banker or a lawyer, wants to see something not get done. But it's also got to be big enough because a lot of these fees are expensive. Ross's fee, and again, there's two lawyers that the company pays for. One represents the underwriter. They typically cost less than the company counsel. I think Jay can tell you what his fee is once you're ready to go before they'll give you, verify your symbol. And you want to make sure you can get it done. And, we've been involved as an underwriter on 6 or 8 offerings this year, maybe an uplist, and they've all been in about that $4 to $7, $8 million range. Although we did do about 3-4 weeks ago, we did a $15 million offering, an Australian company, and there was a lot of excitement on that. And then we'll pass these.
I'll take it and then I'll throw it over to Bill. So let me give you a little bit of a different angle. People will come to me, they see the headlines, and, right now ARM is in the headlines. Everybody's like, ooh, ARM. Yeah, I'm like, ooh, ARM. We get a big guy to finally come to market, and Instacart's coming. And so ARM's going to raise $5 billion, and Instacart, is worth $12 to $15 billion. 2021, just to put into perspective, was a fantastic year for capital market formation. We at the exchange had over 750 IPOs. Okay? There was over 400 SPACs. SPACs are still relevant. They're not going away. And then the cliff, right? We just fell off the cliff turning to 2022. So what happened in 2022? The amount of IPOs decremented down to 161 on Nasdaq from 751. 87 of those were operating companies, and over 3/4 of those operating companies raised less than 25 million. And probably 3/4 of those raised less than 15 million. So when you hear the headlines and you see the headlines of the big guys, it's really the formation of any company. It's the lifeblood. It's your hard work. It's everything that it takes to get public. It doesn't have to be a 20, 50, $100 billion company raising 5, 10, 15. They all matter. It feeds employees, it helps furthers your growth. And if you look at the perspective of the amount of companies going public, the majority are smaller in stature. And maybe it takes them a little bit more time to develop to get to where they want to be over a period of time. But every dollar raised is put back into that company, it furthers your expansion, and they're not going away. We've had, this year, when you hear doom and gloom, there's been 87 IPOs year to date on Nasdaq. We've been very fortunate, very privileged for that. We have another one tomorrow that's going public, maybe a few more on Friday. You're starting to see some green shoots. There'll be big guys, there'll always be the small guys, but to me, I'm not a salesperson. Anybody up here will tell you. I do not work on commission. I'm an educator. I try to get companies to transition from private to public, to really help them, advise them, and really give them all the information which they need and what it takes. And if you're not ready, you're not ready. There's nothing we can do. There are guidelines. Myself And Bill, we're regulatory agencies. We are regulated. So you have to meet minimum criteria. But if you qualify, you do qualify. And then make no mistake about it. We want to see every company listed that's possible.
I'll just add to that. I mean, and John, you said it, it's about, meeting requirement and getting the deal done and being creative. So, work closely with your bankers to do that. I can't show the statistics that Jay just rattled off. We're brand new to the corporate listings business. We launched in June of this year. What I can say is we have about 15 or 20 companies applying with us at various stages that are meeting a variety of the listing standards that you gentlemen referenced before. And it's about being prepared. So, the microcap universe is live and well, and it's evident here and the other conferences that we've attended, and people that I'm speaking to on a daily basis, and we're here to help that deal go to market. And it was encouraging to hear about the Taser and the other medical device or biotech company that's a $2 billion market cap company that started here. So that's what it's about. It's about a foundation. It's about building your value, and then once you do go public, that's where you really go to work as a publicly traded company. And we're an exchange that'll help you as you evolve as a publicly traded company.
So let me ask you this: when everybody that's out here sees the confetti and the celebration going on at the whichever exchange, let me remind everybody, if they celebrate on Tuesday, they didn't decide to go public on Monday or the week before. And very often people ask, oh, did they decide to go public a couple weeks ago? Is it weeks? Is it months? Is it 2 years? I guess, Ross, let's start with you. What's the timeline that you're seeing now from the day that the board says, okay, let's pull the trigger, this is a route we want to go, to ding, ding, ding?
Sure. In 2021, to kind of throw it back to what Jay said, I could have told you easy. 4 to 6 months, when you say go, and you're signed up with a bank, we'll get you through the SEC, we'll get you approved by Nasdaq, New York Stock Exchange, CBOE, and you'll be a publicly traded company. It's a little harder now. And it's not from the legal side or the audit side, which always takes a long time, but it's the capital market side. Because what you're seeing is, although the deals are smaller, it's just becoming more difficult to raise that capital. I'll let John speak to that a little bit more when it's his turn, but that's what we're seeing. So if you come to me today, I would usually say, hey, it's not 4 to 6 months, it's 4 to 6 months in a best case scenario. Now we're probably looking more like 6 to 8 months, and in some instances, even longer than that, depending upon how the markets are looking during that particular time period. John?
Yeah, thanks, Ross. I mean, by the time we get involved, a lot of the work had even been done before the underwriter's been selected. The company has selected their lawyer. But once we're ready to go, and I may digress and talk about some of the service providers, but once we're ready to go, we can probably get it going in 30 days. We've been fortunate that most of our offerings have behaved pretty well once they got trading, and that's always helpful. The look in the rearview mirror is pretty good. So, but I think the other thing, and I again digress a little bit talking to Seth, is work with whether it's lawyers, accountants, and transfer agents that are appropriate for your size business. And what I mean by that is, we had a company that was using CompuShare, computer share, big transfer agent. They do Exxon. We had one company, and I think I've given on a couple of deals where their company's using computer share. It's just to do a $5 million offering, they don't know how to do it. Use a law firm that does a lot of this type of work. We've dealt with law firms like Dentons. They got 1,000 lawyers, big firm, but their lawyers don't know how to do these microcaps. And it's, I'd get involved and ask them things, and well, we don't do that, we don't do that, and I'm like, okay, well, let's get through this. And I will tell you, and I'll give Seth a plug. He's heard me tell this story. About 3 years ago, we were trying to do a closing, of course, on a Friday afternoon. It was a foreign IPO. And I believe it was ComputerShare was the transfer agent. Deutsche Bank was the ADR agent. And I can't remember what law firms. And we're sitting there, and nobody could figure out how to get all the right boxes checked so that ComputerShare could send the stock. And I can't remember if we were doing the booking delivery or somebody else was. It may have been another firm. And and finally somebody said, all right, I'm going to call Seth. And sure enough, the next thing you know, we get Seth patched in. I think you're driving in your car somewhere, and Seth says...
It's always on a Friday afternoon, of course.
I don't know if you remember that call.
Of course I remember.
And it was, I won't mention the names of other than ComputerShare, but it was, Seth said, all right, you got to do this, you got to do this, you got to do boom, boom, boom. And everyone's like, oh, that's what we do? Boom, 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 bang. 5 minutes, somebody figured out how to pull the trigger. Stock left, ComputerShare ended up at the firm doing the booking delivery, but it was, Seth wasn't even on the deal. But
Thanks.
he knew how to get this done.
I owe you a steak dinner.
You know, just work with who's appropriate. Anyway, next.
So many people in the audience are at that inflection point of deciding, okay, so which exchange do I go on, assuming that you have the benefit of making that choice on your own. So Jay, I guess this is, let's give this one to you. You know, Nasdaq has, I think, a pigeonholed reputation as a good one, and you know, my layman's version of that is that it's more of a high-tech play. In other words, companies that are in the tech industry are going to be prone to that. But what is the draw for Nasdaq? Like, is there a certain category that you like to attract? What are some of the benefits that you like for issuers in weighing their options? Like, what should they know?
Yeah, look, it's a fair question, and I think probably one of the biggest misconceptions is that Nasdaq is just a tech exchange.
See, there you go. Yeah, biggest misconception is mine.
No, because back in the day, you know, as we were emerging and we were first electronic exchange, we attracted many of, you know, all the technology companies, to be quite frank. But if you take a look, and if you were to break it down, honestly, by sector, it's pretty well diversified across the board. I would tell you we're a home for everybody, to be quite frank. We have a three-tiered model, one which is geared for our capital markets. There's a step up in your listing qualifications, which is your global market. There's another step up, which is the global select, which has the highest, most stringent listing qualifications amongst any exchange. And the answer is NASDAQ, to be quite frank. From a trading standpoint, it's all under one SRO, so we're a regulatory authority, it's one exchange. So whether or not you list on the capital market, which is more cost efficient, whether you list on the global or global select, if Fidelity or Wellington, or for that matter, any investment manager wants to purchase, or for that matter, sell your shares as well, it's all on the same trading technology platform. So ultimately, it's a little bit different now than it was before, from a period of can I go public, just to kind of jump into what these fine gentlemen were saying before. The window is not open forever. We were in just such a tremendous period of time where at any point you want to go public, fine, we'll soup you up in 4 months, 6 months, doesn't really matter, right? All of us on this panel here. And then, you know, 2022 kind of came, and you kind of saw the writing on the wall at the end of 2021. There were definitely chinks in the armor. And now we're in a period of pockets and windows. So the point of having your partners in place, regardless of whether it's going to be your lawyers, your bankers, you know, your transfer agent, your exchanges, you have to be ready. So stay disciplined, craft your message, stay current, keep all your metrics in order, because when that window opens, you're gonna want to be able to strike when you can. The other thing, and then I'll be quiet, is the whole meme stock phenomenon. I mean, that caused, big and small, it caused a lot of chaos. And so the point of taking 4 months to get public, not so fast anymore. I can assure you, because we've seen it and we've heard from it, a lot of corporates, they get their comments back from the SEC and they go through the review and the regulators, and then it's, yeah, but here's some more non-material comments. Be prepared. You know, pack in a little bit of time. Make sure, again, have all that information. Don't allow them the opportunity to nitpick any piece of the puzzle that you have to put together to become public. So for us, again, big and small, sector agnostic, we're going to lead you up to the wedding, but just remember, when the lights go off from that wedding and now you're married, you're going to need that aftermarket support. I think that for us, that's truly where we do excel. So let me give Billy a chance to.
Yeah, now before you pass the mic, you know, to the reputation of the exchange, I mean, I worked in the 80s at a firm called L.F. Rothschild Unterberg Tobin. And in the 70s, Tommy Unterberg did the IPO for a company called Intel. And when I was there, I guess they'd already done the IPO for Applied Materials, and we did a lot of biotech. NYSE wanted nothing to do with those companies, turned their noses up at them. They were too small, they were too risky. And, you know, that's how, you know, the OTC market, I think it was even before, it was called Nasdaq, was how they were all done. So, you know, they wanted to trade, you know, 1,500 multi-billion-dollar companies on NYSE. But you know, I'll pass to Bill. I'd love to know more about what CBOE's doing.
Thanks, guys. So what's our sweet spot, Seth? What's our value add, and who are we looking to lure to our exchange? I'm not going to call Ford Motor Company tomorrow and ask them to leave the NYSE. I don't think that's going to happen. So we're very realistic on who the early adopters are. And, you know, we purchased a company called the Neo Exchange in Canada about 2 years ago. Since it's been rebranded CBOE Canada. They used to compete against the TSX and gobbled up about 60, 70 public companies in a 7-year period, which was a struggle going against a 200-year-old Toronto Stock Exchange institution. And the companies that they were looking at were purpose-driven, innovative companies that were global in scope, that needed that exchange, that had that global presence. And that's what CBOE offers. We currently operate 5 equity exchanges: the United States, Canada, EU, UK, Australia. We own a market in Japan that will be a traded exchange probably 2025. So over the last 10 years or so, CBOE has quietly been either acquiring or launching through an organic process stock exchanges in the equity space. You know us as the old Chicago Board of Options Exchange. That's not who we are. We're a $16 billion global exchange operator. We're listed on our own market as well. But again, it's that purpose-driven, global, innovative type companies, and right now their market cap, right? And everybody here on this panel can attest to that. They're small raises. Our doors are open. We still have pretty stringent listing standards as well. We have a 2-tier system versus Nasdaq's 3-tier system that Jay referenced before. I remember it so well all those years at Nasdaq. But you know, we are a self-regulated organization, and you've got to meet requirements, and we'll be there to work with you and get you through that process from start to finish.
Great. Ross, let me ask you a question. Every couple of years, it seems like something else is in vogue in the legal community. So the 2 words that have crept up recently: direct listing. Can you elaborate on that process and, in your opinion, how that sort of compares to the traditional IPO route?
Sure. So I think there's been about 12 direct listings in the history of Nasdaq. Does that sound right, Jay?
I don't remember the earlier ones, but give or take.
Give or take 12. So we actually were involved in one of them for a company called Bright Green that got direct listed about 1.5 years ago. You know, it's a different process. There's a valuation process that you need to go to in order to set the share price. You still need to meet certain listing standards, including a certain amount of round lot holders, publicly traded shares for that. Instead of doing having an underwriter involved, you're basically just doing a selling shareholder prospectus, registering shares, and becoming an SEC reporting company. And at the same time, you're applying with Nasdaq or CBOE and explaining kind of how you meet those standards. So I think Bright Green was probably one of the smallest direct listings that's probably ever been done, but the company actually, at least out of the gates, traded extremely well. I think it's come back down since that time. but it was a interesting process. And the key, I think, to a direct listing, and something Jay touched upon, is aftermarket support. Because when you're just talking about selling shareholders and you don't have an investment bank selling into the deal, it's all about finding shareholders and people to drive interest in your company, so you have people actually purchasing those shares in the aftermarket in order to maintain your share price.
Okay. Again, in terms of like the pulse of what's going on in the market, you guys are very much in terms of the details. I'm sort of on the edge of it, but I see a lot of volume, right? So in working with hundreds of companies, just to share with the audience, so what I've found over the last 6 to 8 months is that my Zoom schedule has shifted to a lot of 11 p.m. calls, because the interest level, I think, has spiked from foreign issuers. Yes. A ton of calls with Malaysia, Singapore, Hong Kong. We sponsored our first Singapore conference and sent people out there. There seems to be, more so than the last 10 years, a very strong interest of foreign issuers looking to list in the U.S. I guess, Jay, are you seeing that? Ross, are you seeing that?
Yeah, I'm happy to go. You can go.
Yeah, no, absolutely.
We can all go.
Yeah, we can all go.
Yeah.
Absolutely. We did a deal called V Capital, an IPO Malaysian company in the Q1 of this year. In the summer of last year, we did Treasure Global, another Malaysian company.
Both two of my Zoom calls, by the way.
See that? In 2021, we were actually lucky enough to do the first ever Vietnamese company to IPO to Nasdaq, a company called Society Pass. And we're seeing tons of interest, particularly out of Southeast Asia, less out of China, of companies looking to access the capital markets here in the United States to help build their business and their brand in their regions.
Give it to Billy first.
Okay.
Well, again, I don't have the data and the stats that Jay can share with you, but what I can say is that our pipeline is filled with companies from those parts of the world, and that's really in line with who we are as a global exchange, so that's a good thing for CBOE. But we haven't had one hit our exchange yet, but we're very hopeful that we will soon. But very heavy pipeline, very heavy interest, good companies, quality companies. They are PCAOB prepared already, working with audit firms here in the United States, so look out for more from that part of the world.
Yeah, and look, we're global. I mean, we're seeing activity in Japan, Vietnam, Australia, Hong Kong, China, to the point, very tough. SRFC, the restrictions that are kind of put in place by the government and the regulators there, you need the approval there, the internet writers need approval there, still percolating. The UK, Africa, believe it or not. I've been working with a Nigerian company. Actually had one company list out of Nigeria. They didn't call, they didn't ask for money. It was actually a real company. And so the point is, there's a lot. The biggest thing to remember, especially right now, is that the US, regardless of what's going on in the world, still has the deepest pools of liquidity. And so therefore, you're seeing companies from all around the world that are looking to monetize and to be listed, to expand their business. They're looking to be listed, regardless of the exchange. They're looking to be here, one way or another. And the other end of the spectrum is, in many of these, foreign countries, you're not seeing a tremendous amount, or they don't have a very big foothold on institutional investors. So they're coming to the U.S., great companies are coming to the U.S. to really take advantage of the deep pool of institutional investors that's piggybacked on the retail arm. So we're seeing it a lot. And just on the other point from direct listings, we'll have one on Friday, believe it or not. It's actually a company is spinning out of corporate. They want to go public via direct listing, so we're going to have that. We'll have a small company out of Hong Kong tomorrow that's going public. So the pipeline's pretty robust. And a direct listing, you choose the path in which you want to go for any corporate. You want to do an IPO, fantastic, we'll support you. Direct listing, awesome. You want to do a SPAC, D-SPAC, whatever you want, and then you can now we were approved last year for a direct listing with a primary capital raise. So there is no right or wrong answer, just choose the path which is best for you, and everybody up here, they'll support you any way they can.
Looking back, everybody keeps referencing the good old days way back when in 2021. And I remember distinctly having these conversations with dozens of CEOs saying and as CEOs we all do, right? I'm worth more than that, and I'm not taking that valuation, and I'm going to hold off. And so many of these guys that I'm still speaking to today, you know, the overwhelming majority are like, I should have just gotten out of the gate, right? I should have taken the money, executed, and then done a secondary at whatever valuation. You know, as we see all these high-priced deals, Instacart and ARM, you know, John, can you sort of give us a look under the hood of what are some of these discussions of valuation with the companies? Is there still this huge disconnect, or are the management teams recognizing that this is the way of the world now, or do these discussions go down to the wire till the night before? Like, how does that work?
You know, those discussions are pretty much done before the first S1 is turned. But I have found, in my prior life, I did a lot of work with Reg Ds and private placements. In the public market, it's interesting, most of the companies are less sensitive to valuation. They want to be public. When we're doing private raises, the companies, you know, they wanted a valuation, and a lot of times you just can't support it with a company that either doesn't have a product, maybe it has some IP. You know, but then by the time you're public, you're ready to go public, if you're meeting these requirements, you're going to be, the companies are, we don't have those arguments because they're looking further down the road, that even the management, the founder owns a piece of paper or something that actually has a value, whereas with a private company, you know, it's, how do you really can't, you can't do anything with that value in the early stage. So I've just not had those discussions. I was on a call this morning with a company we were talking about how do we get to a $100 million valuation. And we're like, look, it's justified. And it's probably going to be, we'll be able to do a larger raise. The company's doing 15 to 20 million a year. They're profitable. They have a high degree of recurring revenue. So, you know, that was just a discussion. Everyone's like, okay, great, let's move on. So, okay. You know, back to just the prior discussion, yeah, it's, you know, there's a lot of interest from foreign companies being here. I've done a handful of China-based, Hong Kong-based, Australia-based. I've got 2 Australia companies coming up. We have a company here at NIBA that we're bringing that's a Norwegian-based company in Oslo that is doing a lot of business in Africa. Jay's nodding because they are listed on the Copenhagen Nasdaq. They're already, so it just happens that, you know, they're a little more, you know, mature. But, you know, we do see a lot of, you know, U.S. companies, and that's one of the reasons that we want to be active here at NIBA, is doing a bit more business with U.S.-based companies, not for any other reason than we want to support. Jimmy, you've got a question?
Yeah. You just go into, maybe you touched on it, but it's a real big topic. Why are companies doing the mini IPOs? What's the next step? I think that's important for a lot of the issues in here. If they contemplate an IPO, a mini, what could they do? Why is that so important to set up the next steps of future capital raises? New doors that opens up.
Yep. Well, from my perspective, and again, having spent a dozen years working on the private market, you know, it's hard with raising money for private companies, and you know, the success rate is very small. And when you own it, and if the company doesn't execute, there's not much you can do to realize the value. So, you know, with a public company, there's always a market. Whether you want to, you know, sell it, and we're constantly seeing companies, even ones that are trading for less than 25 cents on the bulletin board or the pinks, that, you know, we're looking to work with them. Another company we've got here right now that fits that description. They've got a very great business, and we're working to get them up to Nasdaq or up to CBOE, which, you know, their choice. So it just, once you've got a publicly traded currency, it's so much easier to go out and raise money. People, you know, there are plenty of people, I'm sure there's some in the room, hopefully from the investor side, that want to give them money because they know they've got liquidity. So,
That's the word.
liquidity, and yeah.
Yeah, no, to John's point, it's like, once you're public, once you get there, you can raise money literally overnight, like we do over what's called overnight deals, where a guy like John will say, hey, I'll call up the company, I can raise you $10 million tonight. And counsels on both sides of the deal are working all night, putting together the paperwork, and pre-market that next day, John's raised you $10 million. That just doesn't happen for a private company. Just a quick story, we brought a company public in 2020, right in the middle of the pandemic. They went out at a $6 million IPO. They've been public for 3 years. They've raised $65 million. $6 million IPO to $65 million in capital raised to grow their business, to meet those milestones, and provide shareholder value for all their shareholders.
It's the vehicle.
Yeah, it's just so much easier.
It's the vehicle. I mean, you take that vehicle regardless whether it's going to be the micro cap or even do the direct. Being listed on any exchange provides liquidity. And at that point in time, you could put a facility in place, you could do a debt offering, you could do an equity offering. It also allows your earlier shareholders the opportunity to monetize and obviously gain some liquidity for themselves, and they could deploy it elsewhere. So it's very beneficial for the corporate. Now you're listed, you raised 5, you raised 10, you raised nothing. 6 months, 1 year, 2 years in, now you're raising 25 for further expansion. You're doing an acquisition. Without the vehicle, without the liquidity, as John said before, being private, especially in this market, it's hard. I mean, it's hard to raise 1 to 5 million. So kudos to all those that invest and kudos to all those that can raise it right now. But once you turn that corner, it's like a light switch. Yeah, go ahead, please.
One other thing I just want to mention is once you're public, your stock is currency.
Yeah.
As a publicly traded company, if you're looking at a roll-up play, acquisitions, you now have a stock that has assigned value to it that someone is interested in. It's not just private stock with a dream. It's, hey, my stock's trading at $10 a share. I'll give you 1 million shares, acquire your company, add to the bottom line.
I mean, go ahead, Bill.
I was just going to add, the gentleman said it's the window, right? So that mini IPO, these small companies that we're speaking to, OTCQX, they're just about eligible for a senior exchange. They need operating capital to build their product, to continue to get that revenue stream in place that, they're in dire need of in some cases. So that window needs to happen. They need to go public. They need that capital raise. And then as these guys said, you can do a secondary offering, and in here they've raised $65 million in 3 years. And that's a success story on any exchange.
Looks like we have a question.
Is there any kind of market for the Levy offerings?
Yeah, and I don't know if Mark Lenowitz is in the room. There he is. Who is the expert? Let me just finish one other thing about being public, whether you go the traditional S1 or F1 route or do the Reg A, is that once you're public, regardless of the exchange, for a year and a day, you file an S3, which then is what's called a shelf offering, and I can have Ross explain that a little more. So it's a whole process. So after a year and a day, you can do an overnight. Once your shelf is effective, and basically what you do is just say, we will want to raise up to a dollar amount, 50 million, 100 million, and once it's effective, it's good for 3 years, and they always, put the kitchen sink in there. You can basically do almost anything through an underwriter. The other thing that you can do once you've got an S3 and you're public is what's called an ATM. And someone in between the talks said, I've got 2 referrals to you to do an ATM. And does anybody know what an ATM is? And I don't mean where you stick your card in and get cash. It acts a lot like that for a public company. If your stock is liquid, you can go out and sell 5 or 10% of the volume on a daily basis, but you say, I want to do something this week. You can turn it on, you turn it off. If you set it, you don't have to use it, but it's a way that we have a need for cash a month from now. You can start to just tap the market, and you don't disturb it because you're only doing roughly 5 to 10% of the volume. Sometimes when you do a follow-on or a secondary, you will issue a fair amount of stock, and you've always got to bring the price down from where it's been to make it attractive. So in some cases, the ATM is a great vehicle once you've been public for over a year.
Yeah. And
What's the acronym of ATM? What is that?
At the market, so it's at the market.
yeah, let me just one other quick thought on that. To me, this is very personal. So, of course, I've been at the exchange for 16 years. Prior to this, I was a partner in a broker-dealer, and we worked with corporates that were deep value, underfollowed, undervalued, and we probably had about 15 companies on a retainer basis that, with the hopes and dreams to raise additional capital and take them public, and then ultimately the financial crisis happened, and that kind of wiped everybody out because there was no capital available for them, and even the cost of private capital was just exorbitant. So having that vehicle, having a platform, whether it's a micro, mini, however you want to deem the IPO, if you got a path and you feel it's right, make sure you're prepared and take it. Don't be afraid. Make no mistake about it. The endless supply of quarterly filings and being regulated comes with it, so there's a lot of responsibility and there's a lot of costs. But the opportunity to being public and the vehicle to use to leverage, I mean, you cannot put a value on that. So again, it's just something, just keep that in mind.
Any other questions? We have time for one more. Sure.
Comment on an ATM. I've been very familiar with ATMs. I'm retired now. I used to be in the securities business. That being said,
Yes, you were.
can't kill you. That being said, in my opinion, an ATM is probably the best deal an issuer can have on their books. Because the difference between an ATM and a secondary is very simple. An ATM, the issuer controls, you control it as the company. While the secondary is being controlled by the broker-dealer. That being said, you mentioned like the price being dropped, when a secondary is announced, all that happens. And the broker-dealer is the one who prefers doing secondary because they like the system of a secondary, plus the pricing is usually different or expensive on a secondary. So an ATM, in my opinion, is something that a company should have, so when a rise in stock happens, they can then piece that stock out and they control it with themselves.
Great. All right, so
Thank you. And then, again, to the question on Reg A, as we're running out of time, Mark Lenowitz, raise your hand. So this man knows more about Reg A than the next 5 or 10 people behind him put together.
True.
So.
Okay, I gave you all permission to walk out at 6, whether we're done or not, so I think we made it on time. Thank you, everybody, for coming, and have a great evening.